Welcome to Module 8 of our Stock Trading and Portfolio Management course. Today, we will tackle one of the most critical aspects of trading: risk management. Risk management. No matter how skilled you are, without proper risk management, even the best traders can face devastating losses. By the end of this video, you understand how to protect your capital and trade with full confidence. This video will guide you on how to protect your capital and also grow your capital without losing your capital. Let's get started. Risk management is the backbone of successful investing or trading. It is not about avoiding losses, it's about controlling them so that you can stay in the game long enough to win. The goal is not to make money, but to preserve your capital and let the market force take its course. Now, we do not trade the market just to make money. Our main goal is to ensure that we are protecting the capital we have while we are trying to grow it. In the beginning of this course, I said something, I think module 1 or module 2 or 3, I can't remember. I said the market is designed to be against the Robin Hood policy or beliefs. The market is a place where the impatient ones loses money to the patient ones, where the greedy ones loses money to the patient ones. The goal is not to look for strategies to 10x your money within few hours. It is the market, the financial market is not a get rich quick scheme. The market is a place where the patient ones milk the money, takes the money, grows their investment, while the impatient one loses money and their money become an exit liquidity for the patient ones. So the goal is not to make money, but to preserve our capital. So anytime you fund your equity account, note this: your goal is not to make money. Your goal is to protect that money you just funded. The more you are able to protect the money, the better it will be for your account, because it is going to grow. Importance of risk management. Number 1, proper risk management preserves capital. Proper risk management preserves capital. Even the best traders have losing streaks. So proper risk management ensures that you don't blow up your account, you don't lose all your money. Proper risk management ensures that you stay in the game for a longer time. Proper risk management, when you're able to preserve your capital, you don't lose out on momentums. You don't lose out on important trends because you have money to trade with. Imagine when you blow up your account and that is the moment there is a bull run which you need to tap into, but you have no capital to enjoy the bull run. So protecting your capital is one great job you must learn how to do in this financial world. 2, on importance of risk management. Proper risk management reduces emotional stress. Proper risk management reduces emotional stress. Know that you have a plan in place helps you stay calm and disciplined. When you know that you've planned every single thing out. For example, I plan to risk 2% of my capital and I set my stop loss and my entry price. Even if it hits my stop loss, maybe I'm only risking around $100. Let's say I have about $1,000 in my account and I'm risking just $50. So if my trade goes sideways, I only loses $50. I'm not losing all my capital. But imagine if I'm setting up with 100% of my capital, 100% of my account equity. I'm spending all the money in my account on a particular trade. If that trade goes sideways, I loses my money. But if I spend only 2% of my account, even if I trade 10 times, I will only be losing few percentage of my money, not all my capital. I'll still have a liquidity. I'll still have some liquidity to position myself in the market. Proper risk management improves consistency. By managing risk, you can focus on executing your strategies without fear of catastrophic losses. When you have good risk planning, you've planned out how you want to run your trade. You want to trade on stocks, you want to trade on cryptos, you want to buy Bitcoin, you want to trade Bitcoin on future or daily trade, and you also want to trade, let's say, GTBank stocks. You check your account equity. You want to diversify into these two different instruments. You plan to spend just 2% of your money on Bitcoin, then 2% on the stocks you're buying. If anything goes sideways, you're only losing 4% of your money. You don't get to lose all. Now you will be calmed. You will have focus. In case if anything happens, you are not losing all your money. Imagine if all your money are placed on a trade, you will not have peace of mind, because if anything goes sideways, you lose all your capital. But imagine a situation where you are only risking 2% of your money on a particular trade. Even if it goes sideways, you cannot have all day as a bad day. There are days when your analysis will pay out so much, it will recover you back. The rule of thumb is do ratio 2:1. We'll go into that soon. So the main goal is to ensure that you protect your capital. Remember this: trading is a marathon, not a sprint. The goal is to survive and thrive over the long time. The goal is to stay for a longer time. The goal is not to quickly make that money right now. The goal is not to look for that coin that will do 100% health X immediately. The goal is not to look for that stock that will do 100% within a year, or within the next 1 month, or within the next 6 months. The goal is to consistently go little by little. No rushing. Go little by little, because it's all about those who can stay. Let me give you this scenario. In a marathon, if you are to run for a long time, let's say for example there's a marathon, the distance will take about 5 hours to get to the last finish line, and someone is just starting, expending all their energy, they are running so fast, and there is someone who is expending not too much energy, because they know that it is a long race and they will need all the energy they could get. They are going little by little without too much, conserving their energy. But you see, the person that started so early, rushing, when they get to a point, in fact the person might even collapse, or the person will might even give up. But you see that person that have been going slowly and steady, keeping the energy, when they get close to the finish line, they can now expend that energy, they conserve energy to push themselves through the finish line. So that is how trading is. Those who are able to stay longer in the financial market are the ones that reap the rewards. Those who garbage in, they will garbage out. So if you are looking for quick risk scheme, do not trade. But if you are ready to stay for a longer time, for a consistent time, Bitcoin was less than a cent in 2010. Today, 2025, Bitcoin crossed $10,000. A greatest shift in wealth for those who wait. Apple's share was less than a cent. Was less than $1 back 2003, 20 years ago. 20 years later, Apple's share is selling for over $200. A $1,000 investment would have been a very great amount right now. So it's all about those who can ride for a longer time, those people who can vision for a longer time, those who can hold for a longer time. Those are the people that the market was designed for, not for those who are trying to get money so quick. So remember this: trading is a marathon, not a sprint. The goal is to survive and thrive over the long time. Position sizing. What is position sizing? Now, we talk about position sizing, we are referring to the number of units invested in a particular security by an investor or trader. The amount of shares that an investor purchased, we call it the position size. How much are you holding in a particular security? We see it as a position size. Now, factors to consider when we are talking about position sizing. 1. Account risk. Now, when we talk about account risk, account or equity account is the amount when you fund your Meritrade, when you fund your AltaFX, when you fund your Chaka or Trove, when you fund your Bamboo. The money in that account is known as equity, account equity. Now, otherwise, in the cheaper language, you call it account balance. Now, that money is important to your wealth. It is important to your growth. Your main purpose is to ensure that you do not lose that money. Your main goal is to ensure that you keep that money intact, no matter what. No matter how bad the market is, you don't lose 100% of your capital. You fight hard, you ensure that you never lose 100% of your capital. Now, how do you ensure you never lose 100% of your capital? By positioning right, by not using all your balance, by not using all your capital. And that's why we have a good rule of thumb which says that traders should not risk more than 2% of their investment capital on any one trade. You should not risk more than 1%, 2%, 1 to 2% of your entire capital on one single trade. It is a bad thing. Now imagine if you traded 10, you open 10 positions and you risk only 2% of your capital on that. Now if you lose, which is not possible for you to lose all these 10 trades, but let's say you lose all these 10 trades, it means that you are losing just 20% of your capital instead of losing whole. So you have $1,000, you lose $200, you have $1,000, you can bounce back. Or you traded, you won 5, you lost 5. And now there's something called risk to reward ratio. We get there. If I'm trading with $100, my goal is to make $200. So if I open 10 positions, out of these 10 positions, I won 5, I still made profit. If I lost 5, I'm still in profit. We'll talk about risk to reward ratio very, very soon. So account risk is all about positioning your account properly so that you do not lose all your capital. Trade risk. You must determine where to place your stop order for a particular trade. The most important strategy to use for this is to always use like 5% of your entry point as your stop loss. Now let's demonstrate. Before we demonstrate, let's talk about proper position sizing, which is the third one. Let's just talk about this one before we go into practical. Now you must learn to calculate your risk tolerance and position portfolio properly. Position sizing is most common with day trader, swing trader, and momentum trader. For those who are willing to invest for a longer time, position sizing is done. Learning position sizing and just have this kind of normal knowledge, except if you want to trade the daily momentum or the swing trading. But if your plans are to trade for a longer time, to invest for a longer time, you don't need to you don't need to set any stop loss. You just invest and take the ride. Now, you need to determine how much capital to allocate to a single trade. As I said, one of the common rule is not to risk more than 1 to 2% of your account on any trade. Now, let's talk about how to calculate our account size and calculate the risk per share, and also understand risk to reward ratio. Let's go into practical. Now, let's get to understand position sizing in a more elaborate way. Now, let's say you funded your account, Chaka, Meritrade, or whatever account or whatever brokers you're using. Let's say you funded with, let's use 1 million naira. 1 million naira. So your capital is 1 million naira. This. Now, you've decided on your own that you only want to take risk, 2% risk from your account. So we are going to say account risk is 2%. You made that decision yourself that you want to only risk 2% of your capital, of your account equity on any trade. So we've decided that 2% is your account risk. Now, let's look for a stock in the market. Let's for a real stock to buy in the market. So here is our Meritrade account. So from here, let's go practical. Don't forget, I opened this account for the purpose of this training, and it is not funded. But be rest assured that whenever you are ready to fund your account, it all goes smoothly. Alright, so I select a portfolio, which is my portfolio. Investment type is equity. You are buying shares. Bonds are for government. I've explained this. Bonds means you are borrowing the government money, which this strategy is basically used to control inflation. When we have high inflation in the economy, the government brings out bonds so that people can bring back money into the government, and they can use this money for capital projects, and in return they give you a dividend. They pay dividend, and also they refund your money as at when due. So we chose equity. Other type, we are buying. Select symbol. So this is where we select an organization to buy. So scrolling. So let's say I want to choose. So let's just choose Guarantee Trust Bank, GT Bank. Now, the current price of Guarantee Trust Bank is 57 naira 35 kobo. That is the last price. So let's just take this as our entry price. So 57 naira 35 kobo. So our entry price is going to be 57 naira 35 kobo, and our exit price should be 5% of this or 10% of this, depends. Now let's go back to our calculation board. All right, so we've calculated our account risk. We've determined our account risk. That means we are only spending 2% of our 1 million naira to purchase or to open a particular trade or to open any position. Now, our entry price is 57 naira, as we saw earlier, 28 kobo. So that's our entry price. Now that we've known our entry price, we need to know our stop loss. Now, before we talk about stop loss, before we determine our stop loss. What is stop loss? Let us discuss extensively on what stop loss is all about. Stop loss and take profit orders. Stop loss and take profit orders. Now, what is stop loss order? A stop loss order is an order to automatically sell a particular position if the price reaches a predetermined level, and it protects your asset, your capital, from excessive loss. Now, this is it. You are entering into a trade at $100. Then you set your stop loss at $90. What does that mean? It means that you are willing to risk $10. $10 is 10% of the $100. So you enter into the market at $100 and you set your stop loss at $90. It means that you are buying this asset at $100. If the market goes sideways, it doesn't go the way you wanted. You've projected, you've determined that okay, you are buying this stock, or you are buying this share, or you are buying these securities or instrument at $100 because you believe that it is going to go higher. You've predicted, you've analyzed the market that it is going to go higher. Maybe you are targeting a take profit order at $120, but now it went sideways. And it went downward. Now, if it goes further, maybe it drops to around $20 from $100, you've lost 80% of your capital. That is not a smart financial decision. So as a smart trader, it is essential for you to set your stop loss not to exceed 10% of the position price. It must not exceed 10% of the position price. Let's go back to our working board. So I'm going to the market with 57.28 naira. So this is the entry price. I want to set my stop loss. So that means I can look for my stop loss at 5% of this. That means 0.05. So 57.28% is the entry price. Now I need to look for my exit price if the market goes sideways. Don't forget, stop loss order is to help us curb excessive losses. So we are entering into the market at 57.28 naira. If the market and our projection, so let's say our take profit, let me find a place. I'll also clear this. So here's my eraser. So this is it. So our take profit, we are targeting that okay, we want to take profit at let's say at 17 naira, and currently the price is at 57 naira. So we need to set our stop loss in case the market goes sideways, so we don't lose too much money. So, and I said we've decided to use just 5%. To set our stop loss 5% below the entry price. So that means 57.28 multiplied by 0.05, which is 5%. This is going to give us 2.86. So what are we going to do? 2.86 minus, so we're going to have 57.28 minus 2.86. That is going to give us 54.5. 42. So our stop loss, we are going to set our stop loss at 54 naira point 42 kobo. That is 5%. So that means when we enter into the market with this at 57, we enter the market at 57.28 naira. If the market does not favor us the way we wanted it to favor us, and it drops to 54.42, what will happen is that automatically the trade will sell, so that it does not drop further and you don't end up losing money. Don't forget, we are only losing 5% of the money. Yeah, you're only losing 5% with your stop loss. But let's say you do not set this stop loss and the market went further and dropped to about 20 naira from 54 naira. You've lost a good chunk of your capital. In fact, it will be difficult to enter into the market the next time because you've wasted your money, you've lost your capital to just a single trade. So as a smart investor, you do not risk more than 2% of your account equity, number one. Number two, you set your stop loss price if you are day trading. Don't forget, all these strategies I'm talking about is for those who are doing day trading, swing trading, or momentum trading. If you are investing for a long time, if your purpose is to invest for the longer time, you do not need to set any stop loss. So for those who will trading daily trade, which you can also do if you have good equity, if you have good capital, we'll talk more about this thing in the nearest future. So we've determined again. So now our account equity is 1 million naira. Make it easier. Our risk, account risk, is 2%. Our entry price is 57.28. Our exit price is 54 naira, which is our stop loss. Now we want to determine this account size. That means how many shares are we going to get with just 2% of our 1 million naira? How many shares are we going to get with just 2% of our 1 million naira? And now when we are buying this, what are the risks involved? How much are we losing? Are we willing to risk or lose if the market does not go the way we want it to go? Now let's do some serious calculation. Our first goal is to understand the risk amount. How much are we willing to risk? So the formula for calculating this, let me change my pen. The formula for calculating this will be account multiplied by account equity or account balance or capital multiplied by the risk amount. So we want to get how much are we really risking. So that's 1 million naira multiplied by 0.02, and the 2% of 1 million naira will give us 20,000 naira. So our risk amount is 20,000 naira. We are to calculate the risk per share. That means how much are you willing to risk to obtain one share? How much are you willing to risk to obtain one share? Risk per share. So let's go ahead. Risk per share. Please just follow my peacock handwriting. So entry price, the formula for calculating risk per share is entry price minus stop loss price. So the entry price is 57, while the stop loss price is 54. That means we have 3 naira. It means to acquire one share, you are willing to risk 3 naira. Per one share, you are willing to risk 3 naira. So that means if it goes sideways, if you buy 1,000 shares, you are losing 3 naira per each share. That means 3 naira times 1,000. That will be your loss. And to fully understand the position size, to fully know the position size, what we'll do is to use this formula. The formula is the risk amount divided by the risk per share. Risk amount, which is 20,000 naira, divided by risk per share, which is 3 naira. So we are going to have 20,000 naira divided by the risk per share, which is 3. Clear that, which is 3. Now, using our calculator, what are we going to get? So 20,000 naira times 20,000 naira divided by 3 will give us 6,666. 6,666. Now, how much does one share cost? To confirm if our calculation is right, now this is it. We are going to spend on a share 57 naira 50 kobo, and the risk is 3 naira. So our account size is, if we are risking 20%, 2% of our account equity, it means that our risk is 20,000 naira. Now that's why we're able to get 6,660. So this is the position size. Now let me get it more interesting for you. Don't forget this whole board scenario, because I'll be mentioning them again, but you won't be seeing them again because I need to write another thing. Now let me clear the board. Now let's go over it again. We are trying to calculate the position size if we are buying using 2% of our capital to buy GT Bank share. Don't forget, the entry price, which I will just denote with E, is 57 naira. While we are planning that our stop loss, which I will denote with just X, is 54 naira. Our capital, which I will denote with just A, is 1 million naira. While our risk percentage, which I will denote with just R, is 2%. Now we are trying to calculate our position size. What it means is that how much risk are we willing to take to acquire the share of GT Bank. Now, for us to calculate, as we've done before, we've gotten this, which is our risk amount is 20,000 naira, while risk per share is 3 naira. And we've divided this by this, we divided these two, and at the end of the day, we got 666. Now, for you to verify if this is correct, multiply 3 by 6666, you are going to get 19,666. So it means that per one share you are getting here, per one Dangote, by one GT Bank share, you are willing to risk 3 naira. So if the trade goes sideways, you are going to lose 20,000 naira. But now, this is not the account size, because if you look at this, let's do this. 6,766 shares multiplied by 57 naira, which, if it goes the way we want, let's use our calculator. Multiply by 666 multiplied by 57 naira, and we are going to be getting, what we're getting is 379,962. So this is the account size. So this is the whole size. This is the position size. This 79,962 is our account size. Now, let me interpret well. We are willing to risk 20,000 naira to buy GT Bank share at 57 naira, so that when we eventually buy, we are going to spend this amount of money. But if it does not buy, we are going to lose this amount of money, which is 20,000 naira. Again, we are trying to risk 2% of our money because we need to buy GT Bank shares. We are risking just 2% of our money. So after the calculation, we got this. So now, if we buy 6,666 shares at 57 naira, if our trade order got filled, we are going to be spending 379,962. So this is our account size, this is our position size. But if it does not go the way we want, we are going to be losing 20,000 naira. That is position sizing. That's how to understand. So when they say something, what is the position of your account, this is how we do the calculation. First thing you do is to determine the risk amount, and also determine your stop loss point. Determine the risk amount and determine your stop loss. Once you determine your stop loss, you can go ahead from there. Next, let us look into risk to reward ratio. Risk to reward ratio. What is risk reward ratio? Risk to reward ratio. Now, the risk to reward ratio, otherwise also known as RRR, is a way to compare the potential profit of a trade to the potential loss. It helps you decide whether a trade is worth taking based on how much you could have gained versus how much you could lose. If I'm spending 1 million naira or something, what will be my profit? And if I lose the money, what will be the impact on my account? Risk to reward ratio. Now, how do we calculate risk to reward ratio? The risk to reward ratio is being calculated by looking at the potential reward divided by the potential risk. The potential risk is the amount you could lose if the trade goes against you, while the potential reward is the amount you could gain if the trade goes in your favor. We said the potential risk is the distance between your entry price and stop loss price. The distance between your entry price and your stop loss price. While the amount you could gain is the distance between your entry price and your take profit price. Let us use our board to understand this better. So we said potential risk is the distance between the entry price and the stop loss price. So our entry price is 57 naira, while our stop loss price is 53 naira. The potential risk, 54 naira. Let's stick to previous statistics. So our potential risk here is 3 naira. That means if the market goes sideways, we are going to lose 3 naira. That's our potential risk. While our potential gain is the distance between the entry price and our take profit price. So let's say we've set our take profit to, let's say, 65 naira. So our take profit is equal to 65 naira minus 57. We are getting 65 naira minus 57 naira, which gives us 8 naira. It means that if the market goes in our favor, our profit is going to be 8 naira. But if it goes against us, we are going to lose 3 naira. Now let's talk about a great rule of thumb in understanding risk to reward ratio. Warren Buffett's good rule of thumb is to use 1:2. 1:2 is considered a good benchmark. Why? Because it helps you stay profitable over time. So even if you win only 50% of your trades, you still make money because your winners are bigger than your losers. Now, let me give you this analysis. So let's say you are sticking to the rule of thumb of 1:2. Now, 1:2, what it means is that you are willing to risk one thing to gain two things. So let's say you are using 2% of your capital and you enter into 10 trades. 10 trades. Okay? 10 trades. Out of these 10 trades, let's say you are risking $10 to make $20. So you are risking $10 to make $20. You are trying to double. 1:2. Now, out of these 10 trades, 5 of them went bad. You lost money. Then out of these 10 trades, 5 of them went up. You gained money. At this rate, let's say you lose all these 5 trades, which basically means you are losing $50. You lost $50. Now, if you check your profit over time from the other venture, from the other trade where you won all the trades, that means you gained $100. So you've recouped your money back, and now we say you break even. So your biggest strategies when you are swing trading or you are day trading is to ensure that you follow this rule of thumb. Never use more than 2% of your capital. Strive towards 1:2. I'm spending one thing to gain two things. If you do it in multiple places, all cannot go bad well, and they will recoup back your money and even give you or even land you in more profits. So in risk management, risks are part of our lives. We cannot avoid risk. We cannot avoid risking our money because the financial market itself is risky. The main goal is not to run from risking. The main goal is to be a strategic risk taker. Be a strategic risk taker. So if you are day trading, if you are swing trading, you should look for positions that are not too far from your entry point, so that you can just scoop out little profit in short time. A 1% growth in your equity, in your capital equity, every single day or every single week is better than a massive 50% loss in your equity. So the main goal as a smart investor is to ensure that you grow exponentially. Ensure that you follow this rule of thumb. Ensure you never risk more than 2% of your capital. So let's say I have $1 million to invest. I want to first diversify. I want to buy ETFs. I want to buy if I'm buying individual shares, I want to make sure that I've read the financials. I think module 3 or module 4, we've looked into how to read financials of companies. I want to interpret their financials. I want to understand their financial positions. Are they making money? Can they pay their debts? Are they paying good dividends? Don't forget, not all stocks are dividend paying stocks. But if you understand the organization, if you understand the business, you can make strategic decisions about your investment. So if you are day trading, don't forget 2% is enough for you. If you are not day trading, long-term investing is the best thing for you. Here is your assessment. Calculate the position size for a trade with a 2% risk limit. Your account size is 1 million naira. Your entry price is 80 naira. Your stop loss price is 75 naira. Screenshot your work and send as a file to Color Your Digitals at gmail.com. Ladies and gentlemen, we've come to the end of this module 8. See you in the next module.